Hello friends, welcome to one more video on Portfolio Manager Certification Examination. This time I am going to take you through the chapter on behavioral finance, which is the part of this particular examination. So if you work with me on the 20 questions that I have created in this particular video, I'm sure it will help you to prepare for the exam. But even before that, I just want to tell you what are the key areas on which you should focus as far as this chapter is concerned. So the first thing that you need to very clearly understand is what are the key differences between standard finance and behavioral finance. That is where you need to make a small note and keep it in your book so that you can refer to that periodically. Then you also need to know the concept of bounded rationality, which is different from the concept of investors being rational. Practically, as per behavioral finance, investors have bounded rationality, and that is very important concept for all of us to know if we want to do well on this particular chapter in the exam. Then please also go through the prospect theory, which has some complicated concepts as part of it. However, I'm sure if you read the material provided by NISM, you will have that clarity. Then you need to understand differences between emotional and cognitive biases. So the biases have been split into these two broad categories. Then also go through the concept of fusion investing. So make note of key points on fusion investing. And finally, what is very important is what are the market anomalies related which are explained by behavioral finance also needs to be jotted down as part of preparation of the exam. Let us now move ahead to the questions, and there are 20 as I told you, so I will take you through them one by one. Which of the following is not true about standard finance? Now standard finance is what we call as the traditional finance also, and traditional finance is one area where the utility theory, the rationality of investors, okay, and other concepts are dealt with. So what is not true about traditional standard finance or traditional finance is the first question. So let us evaluate the options one by one and see what could be the right answer. So if you see this, which of the following is not true about standard finance? Investors are rational and process new information without any biases. Efficient market hypothesis describes random movement in prices. This is true. Risk return trade-off is the foundation of investment, which is also true. Decision is based on detailed analysis, okay, decision is rational based on detailed analysis, which is also true. And decision making is inconsistent given the experience, recency, or loss aversion. Now this falls as part of what is called as the behavioral finance and not standard finance. So this is not true. So the answer is D. The second question is which of the following is not a premise of prospect theory? And if you remember, I told you that you will get questions on prospect theory also. Choices are evaluated relative to a reference point. That's the option 1. People are risk averse about gains but risk seeking about losses. Monetary losses hurt more than monetary gains, and investor decisions are guided by thumb rule. Now investor decision getting guided by thumb rule is not part of the prospect theory, so the answer here is D. So second is also D. The third one, which of the below mentioned represent investing biases? We have already seen that emotional biases are part of that, and cognitive errors are also part of that. So the answer would be both A and B. So this for 3 the answer is C. We move on to question 4. Which of the following is not the assumption of standard traditional finance? So traditional finance is based on certain assumptions, very strong assumptions. Investors are rational, obviously, that's an assumption that they have. Investors are risk averse, which is also an assumption that they have. And investors are self-interested utility maximizers, which is also correct. So what is not correct is that investors are driven by biases. This is again part of behavioral finance. We go to question number 5. Which of the below mentioned example defy assumption of traditional finance? Now we have multiple examples given in the question. So what defies the concept of traditional behavioral finance is what we have to find out. apologies, what defies the assumption of traditional finance is what we have to find out. So instead of making a rational choice of risk return, investors show distinct greed and fear over the course of time. So this defies for sure. Instead of accepting randomness with winning investments, investors attribute it to their skill, which is also defying the logic of traditional finance, and investors getting confused when between a good company and a good stock. So essentially the answer is D, which means all the above are defying the assumption of traditional finance. Now let us move to question 6. Which of the below mentioned statement is not applicable to behavioral finance? Okay, so decision making is inconsistent given the experience, recency, or loss aversion. It is there. Loss aversion is basis, which in turn makes an investor oversensitive to losses. Okay, which is also applicable to the behavioral finance. Decision is ad hoc based on thumb rules, which is also true. So what is not true or not applicable is that risk return trade-off is the foundation of investment. This is part of the traditional finance. Question number 6 is dash 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 is the cognitive limitation of mind where in absence of time or complete information, decision making favors satisficing solution instead of an optimal one. This concept comes from bounded rationality, or rather this is what is bounded rationality all about. So our answer here becomes A. Question number 8 is which of the following bias has two attributes of value ownership and loss aversion? Obviously, loss aversion bias has loss aversion into it, but endowment bias has two attributes of value ownership and loss aversion. Value ownership means, whatever you have invested it, you find that to be the best. The next question is which of the following theory states that people are risk averse about gains but risk seeking about losses? This is very easy to answer. It is prospect theory. We move on quickly to the question number 10. In which of the following biases investors, while dealing with uncertainties, look for representative characteristics and base their decisions on general perception about those characteristics? Now this is where investors have what we define as the stereotype biases. They are dealing with uncertainties and they will look for representative characteristics. Question number 11 is the treatment of salary income differently from tax refunds, okay, and bonus amount is the example of mental accounting. So we treat monies differently. We will be more generous in spending bonus and other income than our own salary. So the answer is A here. Making a judgment about where the price of stock could be on the basis of its past performance is an example of what we call as the anchoring. So this falls under the anchoring. So we have it, which is typically done by the investors if they they have to work on the anchoring part of it. Question number 13. Which of the following is not an example of speculative bubble as per Keith Redhead? So he has given multiple examples in his theory about the bubble. So proportion of unexperienced traders is high, which is true. Uncertainty about true value is high, which is also true. Short selling is easy during the time when bubble has been created. Now this is not true. So this is not the example as per Keith Redhead. So this is what we should consider. D is a valid assumption or an example. Investment promises small chance of profit, but amount of profit is very high. Which of the following mentioned statement is not true about market anomaly? Okay, so a market anomaly is departure of stock price from its expected value, which is true. Market anomaly may be present if a chance of price or asset or security cannot be explained by the current relevant information known in the market or release of new information, which is also true. Anomalies appear, disappear and reappear quite randomly. That also is true. So this is not true. So market anomaly indicate creation of bubble is not true. We have completed 14 questions by now and I'm sure you are with me with respect to these answers. Question number 15, which is an investor's choices will be influenced by how information or facts are presented. Uh, which of the below mentioned behavioral finance concept does this statement describe? This is what we call as framing, which means the way we present the question, you will have your answers accordingly. Question number 16, anchoring biases occur when people rely on pre-existing information when they make decisions, collect all the available information when they take decision, do not make use of information when they take decision, and make forecast about uh, future prospects. So here we will say that when pre-existing information when they make decisions is where the anchoring bias will occur. Now we go to the next question. According to which of the theory people treat money differently depending on the factors such as money origin and intended use? We will say this to be the prospect theory, and that is where the answer lies. Question number 18. Behavioral finance differs from standard model of finance because behavioral finance precludes the impacts of investor psychology. That is what we will put it as the answer. That's whether there is a difference. So that's the question number 18 for you. Question number 19. Which of the following is not true in context of bubbles? Bubbles have often emerged during structural changes in the productivity. Bubbles typically begin with justifiable rise in asset price. Bubbles get created when real economy grows faster than financial sector. No, this is not true about bubble. Cheap borrowing cost fuels bubble. That is absolutely true because people get money easily and they can invest that in the market. Question number 20 is identify wrong one from the options given below. So we are very clear that value investing is Benjamin Graham, bounded rationality is Herbert Simon, prospect theory is Kahneman and Tversky, and portfolio theory for pharma is the wrong example. So with this we have completed the video. Thank you so much for your time. I hope you got a sense of some of the questions related to behavioral finance. Do like this video and subscribe to my channel. Thank you.